Good morning. Today is Friday, December 17th. I'm Joe Terrell, president of Terrell & Company, private wealth managers in St. Louis, Missouri. This is another video update on our thoughts on the economy and investments. And let's start this morning with talking about the new Omicron variant that is spreading quickly throughout the world. This virus is with us now, will probably get worse between today and the next few months. The news here that I think is important is not so much the fact that we're having a surge in COVID cases. It's the fact that the cases are not near as severe as what the original virus was. It is more like the Delta variant that we had earlier this fall. And yes, spreading quickly, but hospitalizations, deaths, and such are down dramatically, even though there is a surge in cases. We think this is important because without hospitals being overrun and without deaths surging, it is unlikely that we'll see any type of major shutdown of the world economy as we did in March, April of 2020. So as it relates to investments, yes, it's having an effect right now here in the first couple weeks of December, and the markets are unprecedented in their volatility. But over the next few months, we do not believe that the Omicron variant is going to cause a major problem with investment markets. We are still very much in the camp that believes the world economy is going to continue to reopen, and as it does, we will see a surge in economic activity. The amount of activity that potentially is out there, we are in the camp that believes some of the statistics that suggest that the world is only about 2/3 reopened. So as we can get the virus behind us, there's plenty more activity to come when the world completely reopens. We like stocks that are tied to the economy, and we'll talk about that in just a moment. What is very important for the investment markets, and I would argue is more important than the Omicron variant of the COVID, and that is inflation around the world and what effect this will have on interest rates and potentially what effect it could have on the economy. Here in the United States, we saw just in the last week to 10 days inflation figures that are just below 10% a year. That's terrible. If that does not lower in the next few months, it'll wreak havoc with investment markets. The Federal Reserve on Wednesday, when they announced the minutes of their meeting, when Chairman Powell gave his press conference, in my opinion, it was lip service to inflation. They basically said, well, we're aware of it, but we want to take our time. We're not anxious to make any radical moves. And although I'm not in favor of radical moves, I think they should have had a little more of a urgency in their voice to stop with the quantitative easing, stop with the money printing, stop with the surge in M2 money supply growth that we have seen since the original virus hit in the spring of 2020. Speaking of M2, since the original virus, M2 money supply is up almost 40%. That's unprecedented in history. and the recent inflation figures are at 40-year highs. This is very important that this be monitored, and investment-wise, a person has to be very careful to stay away from any fixed income that can get caught as interest rates go back up. For now, the markets are ignoring it. The markets believe that the Fed is going to ride to the rescue, and they will not let inflation continue to go at these levels. Consequently, you're okay to stay invested in your fixed income investments. We disagree with that completely, and as the Fed raises short-term interest rates next year, they originally said it wouldn't happen until the end of 2023. Now they're saying it will occur in 22, as early as next spring. We see them raising interest rates higher and quicker than what the markets do, and we also believe quicker than what the Federal Reserve believes they will need to do. We're yet to see labor inflation begin to take hold in the economy, and this will have a major effect. We're yet to see in the averages the effects of housing inflation. These are two big items that will keep inflation moving higher in 2022 and force the Fed to raise interest rates higher and more often than certainly what they plan or what investment markets plan. With that said, we want to call to people's attention, there really is, as it's developed in the last year, two markets out there for stocks. There's been the glamour technology stocks, and then the cyclical industrial stocks. The cyclical industrial stocks, in relationship to the glamour growth, are selling at the lowest level in the last 50 years. The glamour growth stocks are beginning to correct. They're beginning to see that this growth can't go to the moon. With interest rates at zero, they're grossly overvalued, and we're beginning to see a pretty good correction in some of these names. Goldman Sachs had a piece out about a week ago pointing out that 50% of the gain in the S&P 500 in the last 9 months has been derived from just 5 glamour tech stock names. The thing to remember is, as the market capitalization of these companies grow, they have a bigger and bigger influence over the average. So what we are seeing is a underlying deterioration in stock prices, where a lot of stock prices are coming down, while at the same time the averages are staying close to record highs, because indexers and hedge funds and such people are yet to sell that glamour tech. But it will happen, and it is going to happen, and a person needs to make sure that they aren't anywhere near that when that part of the market begins to fall apart. With that said, I mentioned earlier this concept of industrial stocks, cyclical stocks, if you will. There is a new business model afloat. And let me back up and say the reason these companies are cyclical, have been cyclical in the past, is every time business was good and they made a lot of money, they expanded their capacity. And when they expanded capacity, there became too much product on the market. Prices of their selling prices fell. Maybe the economy also suffered trouble, and there they sat with way too much capacity. That business model is over with. And whether it is chemical companies, whether it's paper companies, housing companies, mining companies, steel companies. They are now absolutely pledged that they are not going to expand their capacity. They believe, and they are correct, they'll be much more profitable keeping the price that they sell for high and selling everything they have and not trying to figure out how can we produce more so we can sell more. They're going to produce what they make, sell it at a very high price, and they are not going to expand capacity. The reason this is important is the outlook that people have about commodity prices. The prices for these things are going to come falling back down, and that's going to help solve inflation. No, because the companies are not going to overproduce and see this come down. It's also very prevalent in the energy industry. There was a time frame in high prices where energy companies and independent drillers would go out and West Texas and drill fence post to fence post everywhere they could because energy prices were high. Nope, they're not doing it because they know when they do that, there becomes a glut and the price falls way too much. They are better off just producing what they have at, in the case of oil, $70 a barrel, than they are producing much more and seeing the price fall to $45 a barrel. So we don't see prices coming back down. We also believe these companies as investments are going to earn higher multiples. They're not going to become the cyclical companies that they were in the past, where earnings, sales go up and down like a roller coaster. It's going to be a much more even scenario. So we like these cyclical companies that are selling as if earnings are going to disappear in the next few years when they overexpand. Not going to happen. So we want to wish everyone the very best for the holiday season. We're extremely cautious right now. There are things out there that on these pullbacks can be bought, but not too much. We're watching for those storm clouds that are on the horizon. They're not overhead yet, but they're definitely out there on the horizon to see which way this inflation picture and interest rates are going to go in the next few months. We'll be back right after the end of the year with another update. And as I mentioned, the very best to you and your families for the holiday season. And thank you for tuning in. Brian Curtis, who produces these video updates. Thank you, Brian, for all your help all year. And very best to you and your family.